gave up managing billions to become a better investor. Episode 40, earnings season. Yes, hello, it's earnings season time again. And so for the next, I guess probably 6, 7, maybe even 8 weeks, I was spending lots of time talking about individual stocks, general sector insights, impacts on the markets, where everything's basically going, interpretations of what corporate management teams are saying and related. So going to be a fascinating time as an investor. But before we get there and talk about some of the very early earnings season insights, I thought I'd just spend just a few seconds talking about some sad geopolitical issues over recent days. And I've been to Israel, I think it's 4 times now, and fascinating place, great people, always made me very, very welcome. And I was so saddened to see recent events there. So good luck, really. Best wishes to absolutely everybody there, and hopefully some fantastic progress on all fronts over upcoming times. Now, moving back to earnings season. It's interesting, isn't it? Before we got to earnings season, we had, as I talked about in the last podcast, a little bout of market uncertainty. We had the fear and greed index move into, briefly, deep fear, which of course is an opportunity more than a threat, as we've talked about before. But we've also seen some recent updates from the IMF. Now, as I've mentioned before in this podcast, I'm not the biggest fan of the IMF insights. They are quite useful in terms of what people are thinking and why in many different countries and related. But in terms of macroeconomic sort of predictions for how growth is likely to be over the next year or two, it's rather mixed. Hey, I guess at a certain level, I've undertaken macroeconomic work for enough time to know that, unfortunately, anybody tries to make estimates it's a tough old area. You get much more wrong than you do right. However, of course, the key is to try to get things broadly correct. When I used to do macroeconomic presentations or regular macroeconomic presentations, I used to mark myself, which I always thought was a great insight at many levels, to myself, actually, probably even more than the people I was talking to. But that's always the way you've got to think about macroeconomics. It's not going to give you that truth. It's just going to give you some kind of broader insight as to where things are going, and hence from that, deciding about how to invest in markets. And of course, as we talked about before, let's say the equity markets in particular, look forward, let's say maybe 12 to 18 months ahead. So consequently, you've got to build all of that into where you're kind of positioning your investment portfolio. Hence why the extreme fear point that we had in markets just over a week ago, I found more of an opportunity than a threat. And hence why the corporate earnings season is not about whether companies beat or miss or stuff like that. As I've talked about before, frankly, I kind of feel when I look at the US markets in particular, there's often estimates or predictions are pulled back in order to beat those lowered expectations. And hence why you often see S&P 500 index having a 75% beat rate, which actually is a little bit false, because that kind of tells me if it's just hitting sort of 70-something%, then it's kind of at best A-OK versus expectations going into the earnings season. By contrast, the Stock 600 index, the pan-European index, including the UK, is much better. And so I see less sort of slight mild fakery with the pre-earnings season numbers. If companies beat, then actually they are beating, certainly compared to expectations going into, proper expectations going into the earnings season. Anyway, we'll see on all of that front. All I do observe is that, and surprisingly, we've seen a bunch of US companies see some downgrade recently. I came across a fascinating graphic just over a week ago, actually, showing fewer companies were now doing share buybacks. Totally expected it, to be brutally honest. I'm not quite sure why so many companies felt desperate of the need to do share buybacks when they had a bunch of debt on their balance sheet at the same time. Doesn't make particular sense to me, but hey, there you go. That I guess is an indication of what happens when you have a lengthy period of time with very low interest rates and the like. But another time, again, to talk about the 2010s versus the 2020s. So earnings season's interesting. In terms of the busy weeks coming up, if you take a look at the expectations, this week is relatively light. Some big numbers obviously coming from, in particular, the financial sector stocks at the end of this week. We'll talk about a couple of names that were already reported so far. Next week, it starts to build. And then as you move later on, deeper into October and into early November, it gets unbelievably busy in the corporate earnings season, which of course is very exciting, but it obviously keeps us busy, which I guess is a good thing rather than a bad thing. Anyway, when I look at the corporate earnings season, the other critical thing to always be thinking about is what ultimately you're trying to get out of it. It's not that whether companies are beating or missing, that actually it matters, but only so much. The question is what's already priced in. And this is why trying to have, again, as I said before, too many times probably on these podcasts, that kind of capability to think about, well, what's already priced in? What are people already thinking about? What they already factored in and related? That psychological aspect is so important. Hence why you hear me talking about things like the fear and greed index that almost every other week, it seems, be it if we move into extreme fear or extreme greed or related factors. So kind of interesting so far what we've seen. What we have seen actually is some interesting numbers from two companies well known to probably most people out there, and that is PepsiCo and LVMH. Now, some of you may be more of a fan of things like a PepsiCo rather than an LVMH product. I guess that probably would include me, to be honest. But both companies are super insightful and super important because they're big companies, well-known companies. They always have what I would regard as a great insight into global markets and important what I would call consumer or broader consumer sector names, which are going to give you some feel as to not just what individuals are thinking, but pricing power, what demand there is in different geographies out there, and related factors. So PepsiCo's numbers I thought were pretty good, actually. You had, again, a continuation of sensible free cash flow generation, good capability in terms of broader pricing power, despite the fact it's one of their famous products on a good offer at a local supermarket the other week, and geographically good progress. Now, PepsiCo is kind of interesting. I know a lot of people, and certainly perhaps many of you remember this from your relative youths, will remember PepsiCo versus Coca-Cola, which always seems to be a kind of a popular discussion point about this broad space. But of course, PepsiCo is actually much more than the eponymous product. It also has a bunch of food and biscuits and related areas, which perhaps Coca-Cola is a little bit more focused on, not just Coke, but water and coffee and related other factors too. So I think this has helped PepsiCo actually, this slight greater diversification. I've certainly sort of appraised that and thought that over recent years, really. However, I must admit, I haven't been a PepsiCo shareholder for quite a while. And it's kind of interesting, even though I would say if I look over the last couple of years, when I do my own analysis after numbers come out, what does, when I look at the profitability profile, when I look at margin indications, when I look at free cash flow, we try to factor in what's already priced in and what currently isn't. I've been struggling to find PepsiCo as a cheap share for quite a while now. And it's kind of interesting. The other, about 5-6 business days ago, the stock nearly during that period of deep fear in the markets last week, it nearly got down to that kind of interesting $150, $155 level, which I've actually been waiting for quite a while, actually, certainly in excess of all of this year. And we nearly got there, and then numbers came out. They were a touch better than expected. I guess they were big tick in the box from a broader market expectation. The general markets made some forward progress as well, as finally, I think, an acknowledgement that probably, despite some of the fears about bond markets out there, people are understanding that actually inflation is falling and pressures are rising. And funnily enough, when you get that combination of slightly less demand and slightly higher supply, prices tend to go down on related factors. So I think correctly, kind of that sort of general market backdrop has slightly improved. Hence, we've moved away from deep fear into sort of just fear, or a lighter, more average fear level. So PepsiCo shares went up. I think that's absolutely right. If you do see the stock at $150, $155, judging by what I read the other day, I would just rate the stock as a buy at those levels, but not before. There's no need to rush. There's plenty of other companies, be it in the consumer sector, be it in a bunch of the other sectors that I like looking at. Some of the stocks we'll talk about in a couple of minutes' time. I think you can find some better alternatives. But if you are a shareholder, I guess it's a hold. But if you're not, $150, $155 is a bit more of an interesting level for you. So good start on, and certainly now, I know people say, XYZ companies, the start of corporate earnings season. My goodness, when I was growing up, it used to be various steel and related companies that were the great early insight. But actually, when I look at the world today, I think PepsiCo is a pretty good way to start, and actually a relatively, no, I don't want to say straightforward. It's quite a complex company, actually, certainly highly diversified geographically and by product. But in terms of, from an understanding perspective, quite not the most complex company to look at. Let's put it that way. LVMH numbers were interesting, and we're at that point where you're sort of now over 3/4 of the way through the year. LVMH is still an immensely popular luxury goods company. My goodness, you don't need to be particularly into the world of luxury goods to know that LVMH is a highly respected name. What did I see the other month? That they are now going to become an important person who is going to be involved in the Paris Olympics next year in terms of advertising and related. And, that is wholly indicative, I think, of the correct moves by luxury good companies trying to be truly global, as you undoubtedly have seen, as I've undoubtedly talked about as well, even though most of the world's leading luxury good companies were initially founded in France, Italy, and related. Now they're truly global names where European sales are important, but nowhere near as important as they would have been, let's say, 10 or 20 years ago. And consequently, the rise of developing areas which have become richer with people there with the capability to buy the products themselves, which are advertised on the internet and various other advertising mechanisms in a very successful and sort of attractive way for all potential buyers around the world. You can see why the company has become a truly global name. And it's kind of interesting. I found the numbers which came out just over 24 hours ago as I talk. The numbers were solid. There was nothing wrong with them, but they were just a bit below expectations, not dramatically, not horribly. The States, again, has had some tough comps, really reflecting the fact they were doing such a great job over there in that post-lockdown world of sort of 12, 15, 18 months ago. China has improved and is still improving, but perhaps not quite as a quicker pace as perhaps some people were thinking. The rest of the world is broadly fine. Some certain of the product areas, particularly in the sort of the wine and related drink areas, were slightly below expectations. Again, reflecting some tough comps, particularly in the States. A fact we've seen in a number of companies actually around the world. Overall, though, there's enough for you not to be in deep panic if you're a shareholder. But again, when I was looking for, it's funny, I look back rather boringly, I write down the target level which I would find a company that I don't own as interesting after I've analysed it. And for LVMH, it's kind of interesting. My level for it to be, oh my goodness, I must buy LVMH shares, ceteris paribus, is about €600. And as I speak, the share price is a little shy of just under €700. So it's kind of getting into the, okay, if you're holding it already, then you should be chilling and keeping on holding it. Whilst I would have said perhaps earlier this year when the share price was €800 to €900, actually it was time to take profits. And you may recall that Burberry, I can't say it's my favourite luxury goods company because not particularly a luxury good purchaser myself in terms of the actual product, but from a share price perspective, Burberry has been a long hold favourite of mine for quite a few years, actually. And a stock which I used to buy happily at about £1,600 level, 600 pence level. And I sold the stock earlier this year at prices between £22 and £24 a share. And it's kind of interesting. When I did that, I sort of said at the same time that actually, when I look at global luxury goods companies, LVMH being a good example of that, when the share price was in that €800-900 range, the share price was too high. And we're at that point with Burberry where I think if you're holding the stock, you should chill and keep on holding it. It's not quite back down to my, buy on a bad day sort of level. It's getting closer, but not quite there yet. And so it's funny, as often from a sector perspective, companies, there's some similarity in relative sort of profiles and performance, particularly if the companies are doing broadly the same extent. Now, as it happens, LVMH have generally grown a little bit faster than Burberry and have been a little bit more successful, a little higher margins, maybe some would say higher quality product range, and consequently justify a higher multiple. But that is why I like Burberry, because actually I thought it was a bit underappreciated, certainly when it was kicking around the $16, $17 level. We're getting close to that point now. So something to watch. But LVMH told me that, again, underlying qualitative analysis, that bottom-up stock picking perspective is so important. There wasn't any huge, great macro insight. Yes, tough comps, as said in the States. Yes, as the IMF correctly said, to be honest, there will be continued growth in the majority of the world's countries over the next year. But it's just not easy, not straightforward, not ramshackle, unbelievable growth levels, not the sort of growth levels which during the 2010s luxury good companies came from being quite liked to being very liked and related. So again, two good insights into the early earnings season matters from PepsiCo and LVMH. What have we got later this week? Well, on Thursday, we've got FactSet, which I think is a great company, one I talked about previously. Great super insights into so many, what I would say, relevant perspectives on the broader market. So I'm looking forward to that set of numbers. Additionally, we've got on Friday, as I said already, a bunch of financial stocks out. So JP Morgan, Citigroup, et al. Are out, with more to follow in the next week. So even though, as I've said before, I'm not a big fan of the financial sector at the moment. In fact, my only personal holding in the broad spaces in the insurance area, or broad insurance area, stock like the Prudential, for example, the Hong Kong UK listed company. But ex that, I'm not a holder of banks and related. But am I interested in what they're saying? You bet I am. Absolutely. That's going to be insightful. So some interesting stuff to come up with. Overall, though, this is just the early days of the corporate earnings season. So much more to come, so many more insights to come. But I'll update over the weekend about the latter part of this week in terms of what FactSet and the various financial companies have got to say, and throw in a few more general market insights. And we'll just keep on rolling from there, really. So welcome to the corporate earnings season. Good luck with all your various current positions. But even more importantly, it's not what you own or what you're thinking, it's how you react really to what's being said and what's occurring as the corporate earnings season goes on. And as always, it's not just saying if a company misses or beats or something, listen to the conference calls, hear what they've got to say, and even more importantly, interpret it. Is it factored in or not? What are they saying differently? How would you price that given that all that news today? That matters so much more than whether they beat or missed as per a headline on a TV show or something. Anyway, we shall see. Much more to come in the earnings season and so much more. Thanks for listening. Speak to you soon. Bye-bye.